Let's talk about China, our favorite country to talk about. For years, China's economy was like a rocket ship. Massive growths, massive exports, and an ever blooming real estate market. But now things look very different. In fact, China's economy is in deep trouble, and this week, China unleashed a very big stimulus package to fix the economic problems in China. But the real question is, will this be enough, or is it too little and too late? Let's dive deep into it one by one. China is the world's second largest economy. For decades, it grew at a staggering pace, lifting millions out of poverty and becoming a global manufacturing hub, a global manufacturing powerhouse. But recently, the rocket seems to have lost its fuel. China's economy is slowing down much faster than anyone expected. In 2023, experts were hoping for 5% growth, but now they are predicting something closer to 4%. That may not sound like a huge difference, but for a country like China, it's a big deal. So what's China doing to fix this? This week they have announced an economic package, a package which is full of financial measures designed to jumpstart the economic growth. Economists are calling it a stimulus blitz, and Central Bank of China is leading the charge. Let me break it down for you now. China's central bank is making it easier for people and companies to borrow money by lowering interest rates. The interest rates on home loans are being slashed, making it cheaper to own a home. Plus, the minimum down payment for buying a house is being lowered to 15% even for second homes. This is a big deal now, especially when the down payment used to be 25%. Well, now see it from this perspective. China's real estate market used to be one of the major drivers of its economy. It made up massive 20 to 25% of China's GDP. But now, China's real estate market is struggling. A lot of people bought homes when prices were soaring, but now those prices have dropped and many homeowners are left stuck with expensive mortgages and homes that are worth less than they paid for. China is hoping that by lowering mortgage rates and down payments, they can make home buying more appealing again and get the property market moving. Well, it's not just about the homes. China is also trying to revive its stock market, and they have made a series of announcements in that line as well. First, they are setting up a $71 billion fund to give money to brokers, funds, and insurance companies so that they can invest in stock market. The idea is that more investments will create more confidence and boost stock prices. Second, China is encouraging share buyback. A share buyback is when a company buys its own share back from the stock market. But why are they doing this? Well, when companies do this, it reduces the number of shares available for public, making the remaining shares more valuable. China is giving companies cheaper loans so that they can afford to buy back their shares, and they are setting aside $40 billion just for this purpose. And it seems like it has started working. Chinese stocks saw its biggest jump in 4 years after these announcements were made. Well, the important question is, why did China take these steps earlier? Well, for months now, experts have been calling for a stimulus package, but China resisted. It wasn't until the situation looked too bad that they came up with this economic stimulus package. Sector output was slowing, retail sales were down, and perhaps most worrying, youth unemployment was sky high. In July, reports showed that 17.7% of urban youth in China, almost 1 in 5, was out of a job. That's a crisis waiting to happen. So now, when the clock's ticking, China is forced to take actions. Now, the big question is this stimulus enough to save China's economy? Well, these measures might provide some short-term relief, but experts have a different opinion. They are skeptical because the China's problem is not just internal. Its problems are also driven by external factors. China's exports have been dropping for months now. In April, for example, exports shrank by more than 7%. That's a bad news for an economy where exports make up nearly 20% of GDP. And if the rest of the world isn't buying Chinese goods, it's going to be very hard for China to get back to its old days of glory. On top of that, Western countries are putting up new trade barriers on Chinese products. Whether it's electric cars or steel, Western nations are cutting back on imports from China, and that's another blow to already fragile economy. So what does the future holds for Chinese economy? Well, it's a tricky question to answer. But the stimulus may have boosted the housing market and the stock market in the short run. The external problems like falling demand for Chinese goods and trade restrictions are much bigger things and much harder to fix. That means China might continue to struggle with sluggish growth and we could see more economic packages in the future. It's also worth noticing that global economy is also not in great shape right now. Many countries are dealing with high inflation, high interest rates and slowing growth, which means demand for Chinese products isn't likely to bounce back overnight. Well, in the end, we can say that this stimulus package is a step in the right direction. China is finally addressing its economic problems. But the real question is it too late? Is it enough? With slow growth, high unemployment, restrictions by Western countries, slowing exports, the way of China in terms of improving its economic health is going to be very challenging. But for short term, this stimulus package has worked. But in long run, they have to do something better in order to come back to their old days of glory.